हेलो ऑल, वेलकम टू पिवटल ट्रेडर्स। आज हम डिस्कस करने वाले हैं रिस्क मैनेजमेंट फॉर ऑप्शन सेलिंग। और ये बहुत ही पर्टिनेंट टॉपिक है, बट समहाउ पीपल आर इग्नोरिंग इट बिकॉज हम लोग नहीं जानना चाहते हैं कि भाई ऑप्शंस ट्रेडिंग कैसे टेक्निकली किया जाता है। बिकॉज लोग क्या करते हैं, दे थिंक दैट ऑप्शन ट्रेडिंग इज जस्ट टू मैनेज द डेल्टा, एंड एज लॉन्ग एज यू आर मैनेजिंग द डेल्टा यू आर गुड इनफ। और उसके अलावा कुछ करने की कोई ज़रूरत नहीं है। इसलिए people never try to learn more and be informed about the nitty-gritties of option selling and why option selling is much more technical in terms of the probabilities, in terms of the Greeks. And if you don't understand the probabilities in the option selling, then definitely you're taking a miss, and that is not to neglect. So आज मैं आपके लिए लाया हूँ रिस्क मैनेजमेंट फॉर ऑप्शन सेलिंग का एक छोटा सा क्लिप, जिसमें विल जस्ट ट्राई टू कैलकुलेट डिफरेंट स्ट्राइक प्राइसेस, different strategies in fact, and how those strategies can be compared and what decision can you make by comparing those two strategies. So we're loser in a sense that if you compare the normal returns to the option trading, that would be zero. Okay. And when I talk about the option trading, I'm also talking about the option buying. But if you come on to the side of option selling, then your returns would slightly move on to the positive trajectory. And that thing, if you realize sooner than later, is very good for you. But the problem is that option selling in itself will not fetch you much of a return when you fail to do risk management. And risk management and adjustment needed to be combined with the option trading, and then only you will be able to realize the true fruits of option selling or option trading. So you have to make an attempt, you have to buckle up yourself to bring favorable risk reward ratio by doing what? By doing risk management, okay, and by doing adjustments. Okay, these two ingredients must be there into your plate to have a consistently profitable option selling arena. Okay, now what you do in the process is that you try to achieve a probabilistic edge into your trading career. And once you achieve this edge by mixing risk management, by doing adjustments, and by making decision based upon the probabilities, you will be ending up making an edge into your trading arena. So this edge is quite important for you to be consistently profitable for the long run. Okay, now if I'm to move to the next slide, I have is the main topic of today, the calculating the risk adjusted return. So calculating the risk adjusted returns is quite simple. So what we do is we have an expected maximum profit. So expected maximum profit would be there for us, and then we'll multiply it with the probability of being into the profit trajectory. Okay, and then will ultimately multiply with the risk reward. So what we have is we have a risk reward ratio. Okay, so let's suppose this is r and this is r dash. So what the this thing is signifying is that we'll have this r dash, which is the reward divided by r dash plus r. So we'll get this ratio over here. So what will happen is that this will give us the calculation when we compute the risk reward ratio into the return which we are calculating. So when we are calculating the return, we'll be able to compute the significance of risk reward ratio. Okay, this component will do that. Now this component, the probability of profit, will definitely try to calculate how much possibility is there for us to have a winning streak, a winning income, and the strategy to become successful. So let's just try do an example. Okay, so what we'll do is we'll be taking bank nifty into account, and we'll be trying to make two strategies, one strangle, one straddle, and then we'll be trying to calculate how much is the difference between the returns, risk adjusted returns between the two strategies. So First, let's take the Fibonacci extension, because we are into the uncharted territory and this region is not being explored by the Bank Nifty before. That's why we are using Fibonacci extensions. Uh, so let's just start here. So what we do is, this was the previous resistance point which was broken, and from here the Bank Nifty took off to this level currently. Now we'll trying to just take a pause from where the next pause would be taken by the Bank Nifty. So the next pause can be taken around the above shaded region. So first of all would be the 127, second would be the 161. So these two are important levels, ignoring the 141. So what I expect is that the Bank Nifty should, if it to fall, because it is into a breakout trend, it will not fall below the 0.786. So 0.786 would be the fall, then it will act like this and can go up to 0.127 like this. So for the week, I expect that this should be the range for the Bank Nifty. Whatever is the case, this should be the range for the Bank Nifty. Now, simply put, what we do is, we'll be selling a straddle at the money straddle, which would be something around 39,300. Let's just do that. So we are on 21st of the October expiry, 39,300. We sell on the call side. Let's suppose we sell 10 lots, and we will also be selling the put. Okay, so these two things we sell. Currently our margin is showing around 18 lakhs, so we'll be taking some margin benefit by hedging the positions. So let's just do that, so that the strategy looks so that the strategy looks very much realistic. And let's just do this. So what we'll doing is, we'll be hedging it with the options of around 100 rupees, 40,200. In fact, we should go a little farther, because I don't want it to have much of a fluctuation when it goes on the upper side, because call side IV can crush, and that is another topic to discuss. So what I'll do is, I'll be hedging it with around 60 rupees of the premiums. So I'll be buying here on the call side 10 lots, and on the put side also I'll be buying around 60 rupees premium strikes, 38,200. So yeah, so we have this kind of a setup here, where the maximum probability is defined, everything is defined. So what we'll do is, we'll also develop some other strategy, Strangle, and then finally we'll be taking some decision upon that. So if you look at the break even here, 38,600 to 39,900. So let's just draw our box here, 38,600 to 39,900, approximately this. Okay, let's just mark it with blue, a little bit wider. We have this box here. Now this box looks very safe to us. You see how the straddle is kind of giving us a relaxing situation, where we have anticipated that 127 can be a resistance point, and if it goes on the downside, the 786 is also quite comfortable range for it to fall to, and will be still be into the break even level. Now if I am to go on to the straddle, then I have to decide upon the strike price. So strangle, if I am to go on to the strangle, I have to decide upon the strike prices, because straddle is quite simple, that whatever price is prevailing in the market, I'll be just shorting that. Now for the strangle, let me just take two strikes. So first strike, what I'll be doing is, I'll be doing 39,800, because I look it to be safer and above the 127 level. And below, what I'll do is 38,900 strike. So here the below one, and here on the upper side here. So this would be my strangle strikes. So let's just do that, 38,900 and 39,800. So 38,900 on the put side, we sell this 10 lots, and 39,800 on the call side. We sell this too. Now in terms of hedging this, yeah, these both are around 200 rupees, so we'll be hedging this to get the margin benefit. Now currently estimated margin is around 17 lakhs. Let's just reduce it. So the margin benefit we'll be taking is, would be selling or would be buying the premiums of around 65 rupees again on the put side, and 60 rupees or 65 rupees on the call side. So we have this strategy now, the way the margin benefit is also there, and we have the maximum profitability, and both the strategies have 10 lots in pair, and this is defined now. So now what we'll doing is we'll be calculating the risk adjusted returns, and we'll be comparing these two strategies which we have devised. So let's just first do it for the if you also want to do the break even. So 38,636 and 40,464. So let's just draw this in neutral box for the strangle here. 38,600, 38,600 somewhere here to 40,000. So this would be our second neutral box. Now we can delete the Fibonacci level, and we can also delete these red lines. It's no more, and we can mark the strangle with the green box, and the background can also turn yellow. So you have this very similar kind of strategy where the break even levels are not much distorted from each other. It's quite similar. Okay, so I hope you guys can understand this. So the break even levels are quite comfortable and quite manageable. Now let's just compare the risk adjusted returns. How do we compare both these strategies? So we take these strategies. Let me just take the, and I go to here. Yeah, now what I'll do is I'll be simply calculating the risk adjusted returns. So risk return would be simply put, we'll be looking at the return which the maximum profit is coming around 19.87. You can see that 19.87, we will be multiplying it with the probability of it being true. So the probability of it being true is just 45.37 percentage points. Okay, and if we are to multiply it with the risk reward component, and you see the risk reward component, if you see carefully, it is 1:1.12. so our reward is 1.12 divided by 2.12. Naturally 1 plus 1.12 would be 2.12, which would be the conjecture of the risk reward ratio. So what we have here is, if I am to calculate it on my calculator here, 19.87 into 45.87 into 45.37 percentage would give me 9 point something. Okay, this is also adjusted returns, but I will also be adjusting it with the fact about the risk reward. So again I'll be doing into 1.12 divided by 2.12. So what I get is I get 4.76 percentage. Okay, I get this much. So this is my return from the straddle, or you can say the iron fly. Okay, I prefer calling it straddle because only for the sake of margin benefit I convert it into the iron fly. Otherwise I prefer that. So what we do is, we can write this 4.76 here. 4.76 percentage adjusted risk adjusted returns for the straddle. I prefer calling it straddle. Okay, simply put. So this is a straddle here. Now if I'm to compare about the Strangle here, again I prefer calling it Strangle, don't just get confused or complain about it later on. Now for the Strangle, again we'll be repeating the exercise. So the risk adjusted returns would be something. Again, we have the maximum profit of around 10.75, and the probability of achieving this maximum profit is quite uh, delta neutral in terms of the Strangle, and this would be multiplied with 50.37 percentage points, and again further be multiplied with the risk reward ratio to infuse the risk reward component into our risk adjusted returns calculation. So that would be something around, so the return, you see the risk reward ratio is quite low here. The reward is just 0.61, so 0.61 divided by 1.61. Naturally you have to add the risk component below the calculation. Okay, so if I am to calculate on my calculator here, 10.75 into 50.37 percentage into 0.61 divided by 1.61, so this comes out to be 2.05 percentage. Okay, so this comes out to be 2.5 percentage. Let me just write it here then. Okay, now you look at the risk adjusted returns. So that's why people who get matured into the option selling arena, they prefer the straddle, because the risk adjusted returns are quite high. So you see how comfortably we were able to calculate and know how the straddle is quite a smart decision to make when it comes to the risk management. Okay, and even if you look at the neutral box, the break even points are quite similar to the Strangle. So I hope you like the video. Do comment, subscribe and share amongst your peers. Thank you. Have a great day.